Hello and welcome to this video. In this video, we are going to do A-level question from paper 3, variant 32, May-June 2020, question 2, based on merger of unincorporated businesses to form a partnership. The question states that Amir and Ishan have been in partnership providing IT solutions. They shared profit and losses in the ratio of 3:2 respectively. Raj had a similar business as a sole trader. Raj merged his business with Amir and Ishan on 30th June 2019. The balances at 30th June 2019 were as follows. Amir and Ishan, and for Raj, plant and equipment is $431,000 and $53,200. Inventory is $47,200 and $12,500. Trade receivables are $52,800 and $26,300. Trade payables are $37,300 and $14,950. Cash at bank is $13,600 and $11,300. Capital account Amir is $300,000 and for Ishan it is $200,000. For Raj it is $88,350. Current account for Amir it is $11,100 credit and for Ishan it is $3,800 debit. The following arrangements have been agreed upon the merger. The goodwill of the business was agreed as for Amir and Ishan it's $25,000 and for Raj $50,000. All Raj's assets and liabilities would be taken over by the partnership except cash at bank. Assets of Amir and Ishan would remain at the book value. Raj's assets would be revalued as follows. Plant and equipment as well as the inventory will be increased by 5%. Trade receivables will be reduced by 10%. Raj's initial capital would be $100,000 and out of the amount payable to Raj upon the final settlement, Raj agreed $20,000 would be a long-term loan to the new partnership at an interest rate of 4% per annum. In the EBIT of the question, we are asked to calculate the net amount payable to Raj by Amir and Ishan. So before calculating the net amount payable to Raj, what we will do is first we will calculate the revalued value of the asset for Raj, which is given that plant and equipments have been increased by 5%. So the value of plant and equipment which was given was $53,200 plus the 5% of $53,200 which is $2,660. When we add this, we will get $53,200 plus $2,660 is equals to $55,860. Then we have inventory which is again increased by 5%. So the value of inventory which was given was $12,500 plus 5% of $12,500 which is an increase. So it will be $12,500 plus $625 which will be equal to $13,125. And for trade receivable, it is given that the trade receivable is reduced by 10%. So the trade receivable, the value which was given was $26,300 minus the reduction of 10% which will be 26,300 times 10%, and this will be equal to $26,300 minus $2,630 and we'll get the revalued value for trade receivable as $23,670. To find the net amount payable to Raj, first we have to find the purchase consideration, and for purchase consideration we'll take all the assets. From there we subtract the liabilities. Here what is mentioned is goodwill, which is an intangible asset, and this is 50,000, and this will be the asset which we have to take, as well as we have plant and equipment which has a value of $55,860, inventory which have the value of $13,125, and the trade receivable which have the value of $23,670. And these are all your assets. From there you subtract the liability which we have here is trade payables, and the value which is given is $14,950. Once we subtract this, we will get the value of purchase consideration which is $127,705. This is the value at which Raj business is merged with Amir and Ishan's partnership firm. So this is the amount which is due, which have to be paid to Raj. However, from this amount, when they form the new partnership, Raj have to pay a capital of $100,000. So to maintain this initial capital account amount of $100,000, we will subtract this $100,000, as well as we have one more thing here, that is Raj have agreed to give a long-term loan to the new partnership firm. So this amount, as it is going to be retained in the partnership firm as a long-term loan, have to be subtracted, and hence we have subtracted 20,000 here. So when we take $127,705 and from there if we subtract $100,000 and $20,000, the amount which will be left will be $7,705, and this is the amount which will be payable to Raj by Amir and Ishan when they form the partnership firm. Next, additional information is provided which says that the partners also agreed to the following terms. The profit and the loss sharing ratio among Amir, Ishan and Raj would be 3:2:1 respectively, and the total goodwill would not be maintained in the books. In the B bit of the question, we are asked to prepare the statement of financial position of the new partnership firm on 1st July 2019. So before proceeding and making the statement of financial position, let's do all the calculations in the working notes. We'll start with the capital account because it requires a bit detailed calculation, and then for the other things it is a bit simple calculation which are required. So we'll start with the capital account. The balances which was given for Amir was $300,000 and the capital balance for Ishan's account was $200,000 and the Raj balance for capital account was $100,000. We have already taken the old goodwill for Raj which was $50,000 when we have done the purchase consideration. Now the old goodwill which was $25,000 for the partnership firm of Amir and Ishan have to be distributed among Amir and Ishan using the old profit sharing ratio which was 3:2. So Amir's share will be $25,000 times 3 by 3 plus 2 which will be 5. So his share of goodwill will be $15,000 and Ishan's share will be $25,000 times 2 by 5 which will be $10,000. Now as we have merged both the firms and have formed the new partnership firm, so the goodwill for the new partnership firm will be $25,000 plus $50,000 which is $75,000, and it is mentioned that this will not be maintained in the books of account. That means it will be written off, and when we write it off, then what we will do, we will debit the share of the goodwill to each partner's account, capital account. So when we debit the share to each partner's capital account, we subtract it from the capital account. So here it is $75,000 which is the total goodwill of the new partnership firm times Amir's share which is 3 divided by 3 plus 2 plus 1 which will be 6. So Amir's share which is debited or which will be subtracted to write it off is $37,500, and Ishan's share to write off the share of goodwill will be $75,000 times 2 by 6 which will be $25,000, and the goodwill which is written off from Raj account will be 75,000 times 1 by 6 which will be $12,500. This is the amount of goodwill which will be written off as it is not maintained in the books of account. So now when we total it up, the total balance in the capital account for Amir will be $300,000 plus $15,000 minus $37,500 which will be $277,500, and the capital balance in Ishan's account will be $200,000 plus $10,000 minus $25,000 which will be $185,000, and for Raj it will be $100,000 minus $12,500 which will be $87,500. Now let's calculate the value of all the assets and liabilities for the new partnership firm. For the partnership firm of Amir and Ishan, the value for plant and equipment which was given was $431,000, and the value of plant and equipment for Raj after revaluation was $55,860. So when both the businesses merge to form the new partnership, then naturally their assets will be added up. So it will be $431,000 plus $55,860. So the value for plant and equipment for new partnership firm will be $486,860. In the same way for inventory, the value for Amir and Ishan's partnership firm was $47,200, and the revalued value for inventory for Raj sole trader business was $13,125. So when you add both of it, you will get $60,325 as for inventory for the new partnership firm. Then for trade receivable, it is $52,800, which was the value of trade receivable for Amir and Ishan partnership firm, and the revalued value for Raj business was $23,670. So when we add this, we will get $76,470. Cash at bank, we are not going to take the cash at bank for Raj because it was given in the information that this was not taken, and the cash value for Amir and Ishan's partnership firm was $13,600, and from this there was a payment done to Raj when they have merged the partnership firm, which we have calculated in the EBIT of the question, which was $7,705. So when you subtract this, the cash at bank will be $5,895 for the new partnership firm. Then the trade payables was for Amir and Ishan's partnership firm, it was $37,300, and for Raj, it was $14,950. So when you add this, it will be $52,250. Now let's proceed and make the statement of financial position of the new partnership as on 1st July 2019. We'll start with the non-current assets, for which we have done the calculation in the second working notes for plant and equipments, which was $486,860, and for current assets we have inventory, and we have done the calculation in the third working notes for inventory, and the value was $60,325. For trade receivable, we have done the calculation in the fourth working notes, and we got the value of $76,470, and the cash at bank was calculated in the fifth working notes, where we got the value as $5,895 as cash at bank, and when we add the inventory, trade receivable and cash at bank, we get the total current assets as $142,690, and for total assets we take the non-current assets, that is $486,860 plus the total of current assets, which was $142,690. We will get the total assets as $629,550. Then we'll proceed and we'll start with the capital account balances, which we got in the first working notes. For Amir, it was $277,500. For Ishan, it was $185,000, and for Raj, it was $87,500. When we total it up, it will be $550,000. Then current account balances, which was given in the information for Amir, it was $11,100, which was credit, and for Ishan it was debited, hence it is subtracted here. That is $3,800. When we subtract it from $11,100, we will get the balance as $7,300. Then there was a loan from Raj, which was $20,000, and the current liabilities, in which we have trade payables, which was calculated in the sixth working notes as $52,250. Now when we total this up, that is, if we take the total of the capital plus, that is $550,000 plus $7,300 plus $20,000 plus $52,250, we will get the total equity and liabilities as $629,550. With this, we have completed the statement of financial position. In the C bit of the question, we are asked to explain two reasons why Amir and Ishan prefer asking a loan from Raj instead of from the bank. You see, as Raj is the partner in the new partnership firm, hence he will demand a lesser rate of interest when compared to the rate of interest which will be demanded by the bank. Furthermore, as he is a partner, he will be well aware about the financial statements of the firm, hence there is no need to submit the financial statement here, and the loan can be obtained easily, whereas in case of bank they have to submit the financial statement and wait for getting the loan, which may require time, and it may not be that easily obtained as it can be obtained from Raj. Furthermore, when we take a loan from a bank, we need to deposit a collateral security, because of which the business assets will be tied up, because this collateral security will be depositing the paper of some non-current assets, and this will be the bank's property till the time the loan is paid. Whereas when loan is taken from Raj, there is no need for a collateral security, hence the business assets will not be tied up by the loan. And furthermore, there will be more trust when the loan is taken from Raj. It will be more flexible and easy to pay, because if the firm is not making any profit or is not performing well, then the payments of the interest to Raj may be done in more flexible way. So that is also a benefit when the loan is taken from the partner rather than taking it from the market or from the bank. Next, additional information is provided which says that Amir's friend Lala has just left an international IT firm and wants to join the partnership. In the debate of the question, we are asked to advise whether or not Amir, Ishan, and Raj should admit Lala as a partner, and we have to justify our answer. You can state yes, Lala should be taken up as a partner, or you can say no, Lala should not join the partnership firm, and you can justify your answer stating that you see, if it is up to me, I will say that Lala should not be taken as a partner by the existing partnership firm. No doubt, Lala will have an international work experience and this will be beneficial for the firm and he will bring additional capital. But instead of taking him as a partner, they can take him as a employee and give him a job, because you see here the partnership firm is just newly formed, and because of this previously the partnership firm was between Amir and Ishan, and now Raj have just joined the partnership firm, then they had made the new partnership firm. Because of this, what happened previously, all the decisions related to the firm was taken by Amir and Ishan, and as Raj was a sole trader, he used to take all his decisions. So the profit was also shared only between Amir and Ishan previously, and Raj was a sole trader. He was just the one who is having all the profit. Now, with the formation of new partnership firm, the profit and loss sharing ratio have been changed, the ownership have been diluted, the control have been diluted, and at this point of time, if you add another partner, it will be more difficult for creating any understanding between all the partners, because Lala is a friend of Amir and not a friend of Ishan and Raj, and hence this may lead to lot of conflicts in the firm, and because of this it is not a right time to add Lala as a partner. Let him work as an employee and let them give him a good salary, and once understanding is developed, then later on they can add Lala as a partner. So this is what I suggest, and with this we have completed this question. Thanks for watching my videos and have a great life.